Over the past decade, sustainable finance has evolved from something of a niche allocation strategy into something far more consequential. It's been a structural shift in how capital is priced, deployed, and ultimately held accountable. What began with labeled green bonds, largely proceeds-based, often criticized for some opacity, has steadily matured into a far more demanding discipline, one where capital is increasingly tied not just to intent, but to outcomes. And here in South Africa, where the intersection of climate risk, infrastructure fragility, and economic inequality is particularly acute, that evolution is certainly no longer theoretical. You're listening to the Monocle Banking Podcast, curated by Monocle Solutions, and this week we're lifting the lid on a landmark, first ever in South Africa, water performance-based bond. Now, in South Africa, which is among the 30 driest countries on earth, water security is certainly now a binding constraint on growth. Natural capital, once treated as an externality, is being reframed as critical infrastructure. Which brings us to a landmark transaction announced recently. The Cape Water performance-based bond, structured by Rand Merchant Bank and issued by FirstRand, is not just another green instrument. It is arguably something much more profound. It's a capital markets instrument where investor returns are explicitly linked to verified ecological outcomes. In this case, the restoration of water catchments through the removal of invasive species, increasing stream flow, and all of that flows into very critical dam systems. And as we know, as a region that recently dabbled with day zero, extremely important this. A 2.5 billion rand signal that natural capital isn't just measurable, but investable, and perhaps most importantly, replicable. And it's a transaction that brings together a coalition of actors from the International Finance Corporation, the IFC, anchoring the investment, to philanthropic capital, to conservation science, all structured around a pay-for-success model that shifts the risk and aligns incentives and demands greater accountability. So today we unpack not just the mechanics of the deal, but what it tells us about the next phase of sustainable finance in Africa. I'm joined by Martin Potgieter, Director of Natural Capital at RMB. I love that title. Kalina Miller, Regional Manager at the IFC, and Louise Stafford, the Nature Conservancy TNC South Africa Country Director, who is also the implementer of the bond. So welcome to you all. Louise, let's just start with you, because what's fascinating about this deal is that it forces a convergence that I think historically has been quite uncomfortable. Finance wants precision, it wants predictability, it wants very clean metrics. Ecology deals in complexity, in messy systems, in uncertainty, in long time horizons. And here you've also got development finance sitting somewhere in between, trying to bridge the two. And the bond effectively says, we're going to align all three. So let's start there. What does it mean in practical terms to now have capital markets underwriting ecological outcomes?
Michael, firstly, you mentioned it's the first for South Africa, and we've been struggling over the years with sustainable financing and unlocking capital markets for investing in nature. And this landmark bond gets us there. So what it means is that we're shifting from project-based short-term funding, over-reliance on government, to planning a horizon of 5 years to address water security issues. Also, climate change doesn't only bring droughts. If you look at just the country where we are, there's droughts, there's floods. So how can we use capital markets to address the challenges that we're experiencing in our catchments? So what helps us with is to plan over a 5-year horizon to meet certain targets, and then to look at the long-term maintenance of the work. So it is a shift in ecological infrastructure, as we like to call it, from short-term to more long-term planning.
I love that, because ultimately what we're trying to do is also shift that time horizon in the way we plan, because many of these things require much longer lead time thinking. That also changes our thinking around measurability and repeatability and risk and all of those things. Before we get into the weeds, so to speak, at a high level, Martin, KB, and maybe you can kick us off, KB. We've gone from green bonds to sustainability-linked bonds now to outcome-based instruments. So there's been this evolution. What's fundamentally changed in how capital markets think about impact, Kalina?
Thank you very much, Michael. So essentially, historically, you've had an evolution that went to use of proceeds from general purpose to use of proceeds types of bonds. You mentioned that in your opening. The shift now is gone to outcome-based investing. We see that as the future of sustainable finance. The reason you have an increasing focus on outcomes is because you have a verified impact performance that is linked to investor returns. So you don't have just earmark spending categories. You also mentioned that there's been criticism about opaqueness and how does typically the funding link to the outcomes. So the outcome-based bonds are payment for success model. They link the returns of investors to verified outcomes. And they also transfer a portion of the risk of funding interventions from donors to bondholders, essentially creating an ecosystem where you have a balance between risk and rewards of different participants in this capital market transaction. And what happens is the donors are actually paying only for outcomes that are successful. The investors underwrite a portion of that risk, and conservation activities, the specific targeted investments, are supported by essentially private capital as well as donors or governments in a blended format. So this is the new, much more transparent and replicable model where you have an integrity through the capital markets of targets and actual returns.
And Martin, that does seem to be the critical leap, doesn't it? From funding activities to funding outcomes.
Absolutely, 100%, Michael. I want to continue that thought by talking about the instruments that you mentioned and also throwing a few others into the mix, like debt for nature swaps and biodiversity credits and the like. My first comment will be that we need them all. I don't think it's not necessarily an evolution. My view is that we need all of them because all of them serve for the good. But there's two critical differences for this bond that I think is important to understand, which I think makes it hopefully something that will change the way that the common man on the street think about nature. The first difference for me is the return metric. If you compare it with just a sustainability-linked bond here, the returns of the investor is positively correlated with a nature outcome. Remember, typically in a sustainability-linked bond, the issuer will have a lower coupon rate when they achieve success in a project. So it means that the investor will have a lower return when the project succeeds. But here we have it the other way around. If there is success, if the underlying invasive alien removal program is successful, the investors will achieve a higher return. And for us, that positive correlation is just so important because now the investor for the first time can feel that he's actually investing in nature, because if nature does well, then he does well. Yeah. 100%. And the second big difference is, how do you normally, as a bank, structure a sustainability-linked loan? Is normally you go to a corporate client and they issue the bond, and that bond returns will have something to do with the operations of the corporate. For example, if you're a retailer and you sell fewer plastic bags, then that's good. So you meet your KPI and the coupon drops down a little bit. But this means that the origin of how you find your transaction is very different to what we're doing in this bond, because in this bond, the origin is not where do we have a corporate. The origin is where is the most impactful and large-scale environmental project that we can back. We're not looking for a corporate that's already involved as a stakeholder. So it's a very pure origin. We can start with what's the most important topic for us as a country, and let's say for argument's sake that is water. Then we can go and find the best water implementer and the biggest project, and we can go back that without being that concerned on who is the relevant corporate that's a stakeholder in that environment. I think that's critical because so much of the intervention that we need doesn't have a corporate as a stakeholder.
Yeah.
And this instrument allows us to go find finance for that large project.
Just to push you on that, Martin, how did you manage to achieve that positive alignment, that returns increase as success in terms of the project, in this instance, removing those invasive alien plants? Is that where the blended finance made all of this possible?
100%, yes. And, Michael, we do call it the first, but interestingly, globally, I think increasingly there's a number of instruments being issued with similar sort of a features and a growing global investor base. But this hasn't been done in our country yet, and this is hopefully then the start of getting that done. But what happens here, and we can get to the mechanics at a later stage when you want to focus on that. But here what you have is you've got two parties that have opposite outcomes. If the underlying project succeeds, the investors do better, so they outperform. But if the project does not do well, then they underperform. And what's interesting about that underperformance is they still always receive their capital back, but their coupon is lower, so it's still a low risk outcome for the investor. But what is interesting is if the project fails and the investor underperforms, that underperformance is actually used to fund the project. So what we wanted to do with this bond is we didn't just want to move money around. We wanted to crowd in new pools of capital. And the luxury of this bond really is that you have investors that are saying they're happy to take a risk on nature. But if that risk doesn't come off, so if there's an underperformance, they end up paying for it. So we have crowded in arguably the largest pool of capital in the world, which is the bond markets. If the project does work, then they outperform. So the question then becomes, as you rightfully said, who pays for the project? And in that instance, because the project is successful, you have an outcomes-based funder paying for it, which is different to a typical donation where you give money up front and you trust the implementer to do the best job that they can. In this instance, if the project succeeds, then you pay, but if it doesn't pay, then you either don't pay or you get your money back if you put the money in on day one. So the two parties obviously have to agree to what the outcomes are going to be, which leads then to another point of us having a separate independent design agent that helped us with all of that work. But what is interesting here is we're not just moving donors from one way of donating to another way. We're crowding in many more corporates and similar kind of people who want to make a difference and who want to invest in nature, but they just don't trust the current model. So we're not just moving money around from one pocket to the other. Our hope is that we can crowd in many more pools of capital because of this type of structure.
And it does, again, to your second point of those two components of being around choosing an implementation partner, not necessarily aligned to a corporate, but someone who's in the field with a track record who can give confidence to the ability to execute becomes critical. So Louise, before we come back, Martin, thank you for that, to the mechanics. Let's just interrogate what the project is all about, what it enables. And, I think we're aware that invasive alien plants obviously are very negative for water yield. So what are the actual water gains we're talking about here if we start to remove invasive alien plants in the areas around the Western Cape that you're operating?
Michael, when we did the business case, the model that we're using is water funds. And water funds is also not the be all and end all, but it's one of the tools that we find are very effective. There are more than 40 water funds now across the globe. And the Greater Cape Town Water Fund was the first one in South Africa. And water funds are governance and funding mechanisms. They're based in science and they do the economics. We look at what the problem is we want to solve. What will the return on investment be? In that case, when we spoke about return on investment, but we referred to water return into the system based on the investment. We also compared that to grey infrastructure such as desalination and reuse and groundwater exploration. So in South Africa, we have strategic water source areas. There are 22 of them, the 8% of the country's surface area providing 10% of the water. But these are huge areas. So what water funds do is they focus. So we look at a strategic water source area, we look at a water system like the Western Cape Water Supply System, and we identify where we lose the most water. In the case of the Western Cape Water Supply System, we lose the most water in 30% of the entire Western Cape Water Supply System. In fact, we lose 70% in the 30% of the system.
Wow.
And that 70% equates to 55 million cubic meters. And if one put it in context, it's about 2 months water supply for Cape Town.
Oh.
We did the science upfront and quantified the water losses. And the program we started with clearing invasives in 2018. And we started moving to those very high altitude areas in the mountains where it's very inaccessible. And that's part of the problem. We could never get there because of the inaccessibility of the technical skills that's required to work there. So we've been building this. We started with implementation, as I said, in 2018, and we already cleared 41,000 hectares. But we always knew that we will work ourselves into a corner, and that corner is those very steep mountainous areas, very densely infested areas that cost way more than the flatter areas with less infested areas. So that's where the bond comes in, because we have a funding gap, and the bond fills that gap so that we can clear 55,300 hectares. That's a target. So it's very clear what we want to do. And if we do that, we can reclaim 55 billion liters or 55 million cubic meters of water into the system. So that's the business case. And we started with monitoring the water returns in what we call a paired catchment approach to validate the figures or the science that was done by modeling. So this is a like for like. So we have catchment that is invaded, 2 of them are invaded, and 1 is not invaded. And we compare the water losses between invaded and uninvaded. And when we did the business case, we followed a very conservative approach. And there we calculated that we're losing about 24% of water in the invaded catchment. And through this monitoring, we can already see it's 34%. So there's a very clear win in terms of if we invest in nature and clear the catchments of invasives.
It's fascinating. Those numbers really are. And the fact that you've compared in cost benefit terms this to desalination plants or building dams. The resilient watershed strategy, it's something that was developed in South America. Is that right? Where did this all begin?
It started in Quito in Ecuador in 2000. That's the oldest water fund. They celebrated their 25th year last year, and then the model started replicating because it worked so well. So it's now, as I mentioned, across the globe. Africa, we have about 8 water funds now, and in South Africa, we have 3 so far. The Tugela, the Kruger-Tucanians, and Greater Cape, and we're looking at a water fund potentially for Plet. And in each of these water funds, there's a different problem we're solving. In some cases, it's overgrazing or it's erosion that causes sediment into the dams. Sometimes it's a combination of invasives and land management. So each water fund is different, and the return on investment is different. Sometimes you save cost by avoiding dams from losing their capacity. And before we started this conversation, we were talking about Johannesburg, and we know that most of South Africa's water come from Lesotho Highlands. And there we have problems that we try to solve by building more dams. Building more dams is not a long-term solution because those dams can silt up if the catchments aren't managed. And if we can see our grey and green infrastructure working in tandem, that's the best outcome. Otherwise, it's not, you can't only solve one problem. You've got to look at it both grey and green.
Very, very interesting. How do you take something as complex as an ecosystem like a wetland or, where you're operating and translate that into a metric that can sit in a term sheet? What are the core kind of indicators that matter most here, Louise? Hectares cleared, stream flow increases, or some composite metric? Just take us behind how you sat down and said, right, these are the things that we're going to be held accountable for, and what kind of timeline we're talking about here.
I will also ask Martin to fill in. So in the case of the water bond, we have the specific bond, it's in clearing invasives. What we do is there's models that show us how much water we lose per hectare under different circumstances. So firstly, we look at where invasives occur, and then we categorize it in terms of the percentage area covered. Let's use the example of a hectare. How much of a hectare is covered in invasives, and what type of invasives are they, and how big are they? So all these factors, where they grow, what type of invasives, and the size of it, all have an impact on the stream flow. And the Nature Act or the soil acts as a sponge. So when it rains, water infiltrates the soil. When it becomes saturated, the plants used what they need, then the water slowly releases into the dams. In the Western Cape, we have these long, dry summers and short, wet winters. So when it rains, the water goes into the rivers, reaches the dams. And when we need that ongoing trickle stream flow reaching the dams during summer, because of invasive trees in the catchments, that water then gets lost. It doesn't reach the dams. So if we can intervene by clearing the catchments, water can continuously be released in the dams and it can be available for use. In the case of the water bond, and that's where Martin can talk about it, is we call it the water bond, but actually I don't think, and this is just the market is ready to believe the science that if we clear certain hectares or certain number of hectares, you get the water gains. So for this water bond, the success factor is hectares cleared. We're also reporting on water gains, but that's not the measure. Water gains is not the measure. We started off there, but because the hectares cleared is more tangible, you could see it, it's visible. How do we switch from seeing the hectares cleared versus believing the science that it actually translates into water gains? So it's a 5-year period. We get measured every year and we have a glide path that we need to meet the targets for the bond to perform well. Martin, you may want to talk more from the financing side in the world on how we struggled to make the case for water gains and how we fell back on hectares instead.
Please do,
Yeah,
Martin,
thanks.
because I think that's one of the big questions in markets. Capital markets want precision, and sometimes these things are not as readily measurable as one would like. So how did you manage to overcome that challenge?
That's right. Yeah, thanks, Michael. As Louise said, we actually started off with two metrics. We had the number of hectares cleared and the water stream flow reduction. And then we discovered that because we have investors whose returns now depend on the outcomes, what we're going to do here must be verified independently. And if you have 3 or even 10 people looking at an outcome, they must all agree that that is the outcome.
Yeah.
Now, when it comes to hectares cleared, it should be obvious that you can go look at the hectares, you can go look at the situation beforehand and after. You can have geolocation so everyone can see that it's the same hectare before and after, and the trees have been cleared. So there can't be any argument there. We still have an independent verification agent that will check all of these things for us. But we thought that is something that can go into a financial instrument. Water is a bit different. There's a very large body of scientific evidence in South Africa, in our catchments, that say if you have a plantation of this type and of this age, this is what the stream flow reduction is. So none of us challenged that. We all thought the science was very sound. The problem that we have in our infested areas is that you don't have a plantation where it's one type of vegetation and the trees are all of the same age. So you could have, for example, a hectare where in one corner you've got an infestation of eucalyptus and maybe that's 20 years old. And then in the middle you've got nothing. And on the other side you've got a few pine trees that's, let's say, 3 or 4 years old. The problem now is you can have two different people look at it and say that eucalyptus tree is 18 years old and someone else will say it is 22 years old. So for us, just because these infested areas are so messy in a sense with the different types of vegetation and ages, we said we can't have a bond where financial outcomes now depend on something that people can argue about, because we must be able to verify it independently. Now, there's very exciting technology that's developing very fast. It's called LiDAR. So you fly a drone over the area, and with LiDAR, you can track exactly what the size of each of these trees is, and also over time you discover what type of vegetation it is. But the technology is not quite there yet. Hopefully 2 or 3 years from now we will have all of that technology to translate the models to say exactly what the stream flow reduction is. But in these infested areas, we said because we need perfect integrity for bond one, let's work with hectares clears. Everyone understand that, and there can't be any argument afterwards about what was cleared and what wasn't cleared.
And regrowth, I don't know who wants to tackle this. How is that measured? I mean, or are we, because we're talking about large trees here, it's not like a weed that's just going to pop up again and ruin things in a few years' time.
It actually does. Follow up is super important. And that is one of the challenges that we have in South Africa is years ago with the Working for Water program, lots of investments went into clearing catchments, but for various reasons, it couldn't be sustained due to budget cycles, the need, etc. And if one doesn't follow up over a long term, the invasive trees regrow. So that is something that we are addressing currently with the Department of Water and Sanitation, where we're looking at how we can bring in government resources to maintain the cleared areas. So water funds are long-term programs. They typically 30 years. And we call the initial stages the high impact phase, when you remove the large trees, the dense infestations, and then it goes into regular scheduled follow-ups, and then maintenance, which is going back to the same site in every 4 years, for example. As long as that is maintained, the water benefits accrue while the cost comes down. So it's super important to also maintain, because the trees grow back, as you say.
What does that mean, just to press you one more time, Louisa, before I want to come back to you, Kalina, on what gave the IFC confidence? But what does that mean, Louise, from a job creation perspective? Because there's a deep social element to this as well. It sounds like quite a labor-intensive, ongoing job, this.
Yeah, it is labor intensive. What we've done for the first time in South Africa, this specialized work is provided by small businesses, and they've been trained over the past 7 years in high altitude work. So that job creation portion, or the job opportunities portion, is very important. But more importantly is the skills that go with it, the small business development, and the fact that it's a specialized service. So we have 3 types of contractors or skill sets that we require. The one is what we call general work. So if you can imagine a flat area where people can walk in, they can park a vehicle, walk in. The second is what we call intermediate. Those areas are people have to camp because the walk time is too long. You can imagine people arriving at the site, say 7 o'clock in the morning, and if they have to walk for 3 hours to get to the work site and 3 hours back, there's 6 hours gone. So those teams fly in and they camp, but it's not as technical as the last one, which is high altitude. And those are people who work on rope, very steep slopes, highly specialized teams. And we have, over the years, with the Greater Cape Town Water Fund, created over 1,300 job opportunities. But a job opportunity can be a week or 2 weeks or a month or a year. So we are looking at job creation, where we're looking at a longer employment, and we do a social study every 3 years. The last one we did, we had about 157 people that what we call jobs. So it's people that work for longer than 2 years every day, except for holidays. And, these people often work over weekends because we fly them in, leave them on the mountain for 2 weeks. They set up base camp, and from there they operate. So,
Wow.
so the skill set is, I think, the one game changer, where we have people that can now provide that service. And as we replicate water funds, we can replicate the skill set, and more people can get jobs. Yeah, and there's women, and we do 50% of the overall workforce are women, but on the high altitude teams, we have 150 of them, and 47% are women. So we also have women, but such technical and high security work that it's good to have women, but the focus is safety and making sure that we have the right skill set.
Yeah, absolutely. Well, if you ever need a volunteer, I love hiking and climbing in the Cedarburg, and I could think of nothing better than camping on a mountain for a week. But it just is.
We'll take you up on that one.
Fantastic. Thank you, Louise. Now, Kalina, I want to bring you in. The IFC anchored roughly 1.6 billion of this issuance. It's not small change, that. I mean, what gave you the conviction to back something this novel?
Thank you very much, Michael. I think I wanted to put this particular investment zoom out and explain why it was important. For us, this is, as we've highlighted, it's the first of a kind, very first nature-linked outcome-based bond issued by a commercial bank globally. And this is the very first that IFC is investing in also globally. The World Bank did pioneer outcome-based bonds, but those were issued by the World Bank itself. So there's no private sector equivalent. So we look at this investment as it's very important to us. We're very proud of it because it's the first of a kind globally for the private sector. And most importantly, it is something, as it's been mentioned earlier, that we're looking to as a blueprint that can be replicated across markets and across various asset classes, whether that's water or other social outcomes that are important to address development challenges in emerging markets and also in emerged markets. So from a strategic perspective, this is a very critical and very pioneering landmark transaction. It helps to mainstream nature positive finance. It sets standards and creates a new asset class. The reason we got comfort in it is because of the overall structuring and all the various components that were outlined throughout this conversation. We were an anchor, but we're also very, very involved in some of the structuring. As you can imagine, a lot of these outcome-based bonds, they have to be calibrated to the specific conservation or other activity that they're supported. They have to have KPIs that are transparent, verifiable, and simple, as Martin and Louise outlined.
Yeah.
So here you have basically historic projections on what's been done, very precise projections on what would be the KPIs linked to invasive species removal in terms of hectares cleared with glide paths and technical agents and projections. The secondary impacts are also critical, but they were not linked to the returns, as has been highlighted. However, water saved and employment created are also very critical. But the technical aspects and the historic data that are part of this structure is what gave us a lot of comfort. Also, to underscore what was important is that the actual credit risk that investors take for the principal is linked to First Round as an issuer. That is also what gave a lot of comfort. So the principal is not linked to the conservation activity outcomes. Only the coupon is, and the return based on the coupon is linked to the outcome. So some of these technical structuring aspects, the verification behind it, the transparency is what gave us comfort to make this investment and to support the new asset class that we hope to scale up across with partners.
It's really, you look at this as a scalable model and you think, wow, you could potentially see this being used elsewhere. Carbon sequestration projects or biodiversity restoration, for example. Coastal resilience is another one. There's so much that springs to mind. And effectively, it's almost as if the bond is offering this downside protection with upside linked to successful outcomes. And it almost looks like a structured credit product with an embedded impact option. Maybe I'm extending myself a bit too far here, but Kalina, would you say, and you said it's a new asset class, would you say we're moving towards a world where ecosystems sit alongside infrastructure and real estate in portfolio allocations as a standalone asset class?
Absolutely, Michael, and I think we've made that point throughout the discussion. We do look at this as a new asset class that ties investor returns to outcomes. Martin was very right that we will continue to need other asset classes depending on investor allocations and appetites, but this definitely offers a very transparent mechanism to tie investor allocations, impacts, and returns in one capital markets transaction.
Martin, RMB calls this a replicable template in the release, and from what we've discussed, Kalina's also said this looks replicable. What needs to happen for this to scale across Africa?
Yeah, Michael, like any new asset class, what we need to do as the designers of these bonds is we need to keep it as simple as possible. Now, I think everyone understands the number of hectares cleared. No one will have a question around that. And I think, as Kalina said, it can be used for many other things like social outcomes, education, and the like. But Michael, for this to work, there's a number of things that we need in each of these bonds. Firstly, you need a good implementer. Now, I think there's lots of good implementers all over Africa. but they don't all have the data that Louise had. As an example, Louise has cleared, or TNC South Africa have cleared about 860 different areas that they gave different contracts to the people doing the actual work. But for each one of them, the area was locked, the budget was locked, the number of days it took, the level of infestation, the difficulty of the terrain, which enabled us as the bank to go analyze what is the probability of them achieving their hectare clear target over the next 5 years. So what you need firstly for this market to develop is you have implementers. They need to start thinking like investors. They need to, for example, if you're a CFO of a company, you can provide numbers for the last 5 years of your company, and the investment analyst can then sit and understand what the history is, and therefore he can forecast what the future is going to be. If you don't have that for the implementer, for the area, and for the project work, it's going to be very hard to convince the investor that they will be able to achieve their return. So that's the first one. The second one is supportive investors. And I clearly remember, so we haven't been working on this just for 6 months. It's been, I think it's about 2.5 years ago that we started working on this, and we worked on a number of bonds that didn't come to fruition, unlike this one. And I remember clearly a conversation I had with one of my colleagues in Treasury about a year ago, who said, you know what, we need to talk to the IFC. They will support something like this. And every little conversation we had like that first you bring in the anchor investor, then you bring in the anchor this or an anchor outcomes-based fund. Every one of those little conversations moves it on and gives it momentum and get the bond to where it is today. So the second thing you need is a supportive investor base, and you would have seen some of the names of some of South Africa's largest investment managers in there as well. So you're going to need their support to roll this out. And then obviously we need to create a platform of outcomes-based funders. Water is very easy in a way to sell, because if we're going to start a water project in Cape Town or Johannesburg, you should be able to go and talk to the corporates that use that water and get them to become an outcomes-based funder. I would imagine, but if you compare that to a project where you want to rehabilitate a landscape in, let's call it the conservation landscape, where you want to rehabilitate the population of lions, elephants, rhinos, and the like, it is a lot harder to get corporates and other people to understand the economic rationale of that, because they don't use them necessarily every day. So the third thing we need is that platform of people, institutions, foundations, corporates, and the like, that understand the purpose and the need for this particular project for them to then fund into a bond like this. And then obviously we need the capital markets to work. I do think now that some of these outcomes-based funds that the World Bank has done, is the first one is only 1 year away from maturity, and I believe it's had success in the first 4 years. And I think as and when these outcomes bonds mature and investors understand that their returns were better than they thought they would be, that will also then again catalyze, I hope, a new cycle of these things. But I think that's the reason why it hasn't been done by a commercial bank before. It's quite complicated to get all of these things together. But in this instance, it really did work. And I think that also means that when we think about what is next for us, you start thinking, well, we now understand how the IFC team think. We understand how TNC is doing these programs. So if you want to replicate it very quickly, why don't you just repeat it over and over again? And over time, those projects that I've mentioned that are a bit harder to get your head around from an economic standpoint, and then you can crowd them in as well, because the investors will start asking for something that's a little bit more interesting than just, let's say, for argument's sake, the 5 water bonds that they did in the previous 2 or 3 years.
Sorry to interject. I just wanted to underscore 2 more points in addition to what Martin laid out. Obviously, in addition to having the supply typical challenges for capital markets transaction between supply of investable projects, demand from investors, and intermediation mechanisms, for this particular asset class, you have the complexity and customization which is required, which is different than just typical use of proceeds bonds. But I do believe very strongly that if we have, like we've done in this case, created one model, the replication would be a lot more efficient. And we already see quite a bit of interest in similar types of activities. We have learned quite a bit from this experience over 18 months, but keeping it simple so that investors and then the actual conservation or target activity can speak to each other in very transparent matrix, and customization to the activity is what makes it more complex. But I do think we can overcome this based on the model. The replication would be easy is essentially my key message.
Yeah, I can also see it shifting on the implementation side. Those implementers who are doing good work but maybe not thinking so methodically about their data systems and their monitoring frameworks, and maybe having the financial literacy within their conservation teams to get that in order to become a partner to go and implement something at scale through this kind of model. So, Louise, maybe just to give you the final word, and given you're now effectively part of this multi-stakeholder financial architecture, how has your role evolved in a transaction like this? And what are the lessons maybe that you've learned that you could share with other implementers, NGOs working on nature-based solutions that they can start to think about in order to go to the capital markets with potential fundable and bankable projects similar to yours?
Yeah, what changed for us, or for me and the team, was how we had to think more like the private sector. And the private sector had to think a bit more like the conservation sector. So we had to adapt our way of thinking. As we developed the bond, we often asked each other, and the litmus test was, what will the investors think? So we had to tweak the thinking and the evidence that we provide on both sides. In the sector, this water bond is a shift in the sector, the conservation sector, because we've been talking about public-private financing, unlock bankable projects, unlocking sustainable financing for years now. We don't have enough examples. So firstly, this gives us that example of, okay, it can be done. And the lessons learned here is, how do we change our thinking from activity, and it's been mentioned before, from activity to impact. Also, that link to performance, it's new for the sector. So that is crucial if we want to do business with the private sector. So it changes how we think about transparency. And if there's a word, I would use it, professionalization of the sector. We've got to become professional in what we do. And then science. We cannot do this work without the baseline of science, good data management, and then track the impacts, have the right skills. And I wonder how ready the conservation sector is for the risk that we take on, because it's a risk. So we have 5 years to hit targets. If we don't hit these targets, there will be repercussions. So how do we shift to that? And we find it often with legacy projects, that we know we can clear aliens. We're not clearing aliens. We are restoring ecosystems to function. And for as long as we clear aliens, we will have to redo it. But if we shift from the impact, the long-term 30-year program, to changing ecosystems, getting them healthy so that they can provide the services and buffer us against climate change. And if we don't have that shift and become professional, I fear we will struggle to roll out more bonds.
So beautifully and eloquently put. My thanks to all of you, Louise Stafford from the Nature Conservancy, Martin Potgieter from RMB, and Kalina Miller from the International Finance Corporation, because if this is what pricing nature looks like, it does look like capital markets may finally be catching up with reality. You've been listening to the Monocle Banking Podcast, curated by Monocle Solutions. I'm Michael Avery. Until next time, take care.